Imagine your broker goes bankrupt tomorrow morning. Like you wake up, you grab your coffee, turn on the news, and you see federal agents literally carrying cardboard boxes out of firm's headquarters.
A total nightmare scenario.
Right. The doors are padlocked. The CEO is in handcuffs. You log into your account on your phone, and it shows a balance of $600,000. How much of that money do you actually get back?
Yeah, that is the big question.
Think about it. If you believe the answer is a clean $600,000, you are in for a terrifying, mathematically brutal surprise. Today, we are tearing apart the invisible rulebook of Wall Street to see what actually happens when the system breaks down.
And more importantly, how the system is supposed to run when it's actually working properly.
Exactly. Hey, before we unpack today's massive topic, this deep dive is brought to you by CertFuel. If you're gearing up for the SIE exam, they've got a full Securities Industry Essentials course with adaptive study quizzes, smart flashcards, and unlimited practice exams weighted just like the real thing.
Which is so important for pacing yourself.
It really is. It's exactly what you need to crush this material. Check it out at certfuel.com.
Okay, let's dive in.
I am ready. And for those of you listening who are studying for the SIE, we really need to set the stage for why this specific topic matters so much.
Yeah.
We're looking at the books, records, privacy, and communications section of the exam.
Which, I mean, let's be honest, doesn't sound thrilling on its face. It sounds like reading a dictionary.
It does. It really does. But here's the reality. This section makes up 31% of your entire test.
Wow.
Yeah, that is almost a third of your score. 23 questions are standing between you and a passing grade, and they are all buried in this material.
So you can't just skim it.
No, absolutely not. But more than just passing a test, this is the actual rule book for human behavior in a high-stakes environment. Financial regulation isn't like an x-ray where a broken bone is just obvious.
Right.
It is a landscape of nudges, of suitability, of trying to legislate human intention. It's muddy, which means we can't just memorize flashcards. We have to understand the actual human beings navigating this muddy water. So to make this stick, especially if you have ADHD like me and need a story to follow, we are going to use a cast of characters today.
I love this approach.
Yeah, I want you to picture a slightly dysfunctional brokerage firm. First, we have broker Benny. Benny is our enthusiastic, high-energy registered representative. He means well, he really does.
But he's a liability.
Totally. Benny is a hustler who constantly leaps before he looks. He's always one poorly phrased email away from a massive compliance violation.
I mean, every firm has a Benny. They generate a lot of revenue, but they also generate a lot of gray hair for management.
Exactly. Then we have customer Kathy. Kathy is our wealthy, globe-trotting retail investor. She has a complex life, a lot of assets, and she wants her money to grow, but she doesn't want to be bothered with the minutiae every single day.
She is the archetypal retail investor, and the regulations we're discussing today were explicitly written to put a protective shield around people exactly like Kathy.
And finally, the man responsible for holding that shield, Manager Mike. Mike is the stressed-out registered principal at the firm.
Poor Mike.
Right. It is his legal duty to approve Benny's chaotic ideas, keep the regulators from knocking on the door, and basically ensure the firm doesn't get shut down. Mike's blood pressure is permanently elevated.
And Mike is crucial for the exam because FINRA loves to test you on what the principal is legally required to do when the broker makes a mistake.
Okay, so let's set the scene. Segment 1. Benny has a hot new stock tip. He wants to build his book of business. But before he can manage Kathy's money, he has to actually get her on the phone.
Right.
And in the securities industry, you can't just, buy a list of phone numbers and start dialing. There's a massive regulatory hurdle right out of the gate.
Yeah, there is. We are dealing with the Telephone Consumer Protection Act, the TCPA, and FINRA Rule 3230. Historically, back in the 80s and 90s, telemarketing was completely out of control.
Just nonstop calls during dinner.
Exactly. Dinner time was an endless barrage. So the government stepped in. Now, what most people misunderstand is that they think there's just one big do not call list.
Right, the national one.
But for a broker-dealer, there are actually two completely separate lists they have to cross-reference before they ever pick up the phone.
Okay, so it's not just the Federal Registry.
Exactly. The first list is the National Do Not Call Registry. That's the one everyone knows, maintained by the FTC. If a consumer puts their number there, it's a blanket ban on telemarketing.
Right.
But the second list is the firm-specific Do Not Call list. This is an internal database maintained entirely by manager Mike at Benny's specific firm.
Okay, let me test a scenario on you to see how these interact. And listener, pay attention here. Let's say Kathy is absolutely not on the national FTC registry. She never bothered to sign up for it. Benny randomly cold calls her, launches into his pitch, and she cuts him off. She says, "Benny, I am eating dinner. Do not ever call this number again," and she hangs up. Since she's not on the federal list, can Benny just wait a month, assume she cooled off, and try again?
No, absolutely not. And listen, this is exactly where the exam tries to get you. The rules operate independently.
So her word is final.
The moment Kathy says, "do not call me," Benny has a strict legal obligation to put her on his firm's internal firm-specific do not call list. It doesn't matter that the federal government says she's fair game. Her direct instruction to the firm overrides everything.
So how fast does Manager Mike have to update that internal database? Like if Benny tells him on a Friday, does it have to be active by Monday?
The firm has a window. The request must be honored and take effect within 30 days.
Okay, 30 days.
However, the more heavily tested point is how long that internal ban actually lasts. A firm-specific do not call request is valid for exactly 5 years from the day it was made.
5 years. Not forever, not 10 years. So on day 1 of year 6, Benny could technically call her again.
Technically, yes. Though Manager Mike might advise against poking the bear.
I'm sure he would. Okay, let's talk about the clock itself. Because Benny is a grinder. He loves to work late. I want to throw a time zone hypothetical at you.
Let's hear it.
Benny is sitting in his office in New York. It is 10:00 p.m. at night for him. He's drinking his third espresso. He wants to call a prospect in Hawaii. It is 4:00 p.m. in Hawaii. Is this a violation because Benny is working so late?
No, it is perfectly legal.
Wait, really? Why?
Because the regulation exists to protect the customer's peace and quiet, not to enforce labor laws on the broker. The telemarketing rules state you can only call between 8:00 p.m.,
Right.
but it is entirely based on the customer's time zone. Benny's clock is completely irrelevant.
Okay, so let's flip it. Benny gets into the New York office at 7 a.m. He's feeling great. He calls a prospect in Los Angeles. It's 7:00 a.m. in New York, which means it's 4:00 a.m. in California.
Massive violation. He just woke someone up at 4 a.m. The fact that it was 8:00 a.m. in his own time zone doesn't save him. Always default to the customer's perspective.
Okay, I want the listener to actively think about this next scenario. Yeah. Stop what you're doing and think. Let's say Kathy is on the National Do Not Call list. She signed up for it years ago. She hates telemarketers.
Makes sense.
But she actually bought some mutual funds from Benny about 10 months ago. She has an active account. Can Benny call her today to pitch a new municipal bond? Well, I'll give you a beat.
It's a tricky one.
The answer is yes, he can. But wait, why? If she's on the National Federal Registry, shouldn't that be an impenetrable shield?
It is a shield, but there's a massive carve-out called the existing business relationship exception.
Okay, what does that mean?
The SEC and FINRA recognize that if you already do business with a firm, they need to be able to contact you to service your account or offer related products. If a customer has an established business relationship, meaning they have an account or they made a transaction, the firm can completely bypass the National Do Not Call list.
But that can't be a lifetime pass, right? Like, if Kathy closes her account, Benny can't just call her 20 years later.
Correct. The exception has an expiration date. An existing business relationship allows the firm to call for up to 18 months after the last transaction.
18 months. So even if she moves all her money to a competitor, Benny has a year and a half to try and win her back legally.
Exactly. Now let's contrast that with a much softer interaction. What if Kathy never opened an account at all?
Like she just asked a question.
Yeah, what if she just saw a billboard for Benny's firm and called in to ask what their management fees are? That's not a business relationship. That is an inquiry.
So how long does Benny get to call her back based on an inquiry?
Only 3 months. An inquiry is a much weaker signal of interest, so the regulatory window is drastically shorter.
So 18 months for actual business, 3 months for just asking a question. Listener, this is where the exam tries to get you. Do not mix up those two numbers.
It happens all the time.
Okay, let's say Benny navigates all of this. He checks the lists, he verifies the time zone, he has the 18-month exception, he picks up his desk phone. Can he use a feature to block his caller ID so it just shows up on Kathy's phone as unknown caller? Benny thinks it makes him seem exclusive and mysterious.
If he does that, Manager Mike is going to fire him on the spot. Benny absolutely cannot block his caller ID.
Not at all.
Never. The TCPA rules mandate strict transparency. When he makes a telemarketing call, he must provide his individual name, the name of the broker-dealer he represents, a standard callback number, and an address.
And he has to be honest about why he's calling, right? He can't say, Hey, Kathy, I'm just calling to take a quick political survey and then bait and switch her into buying a stock.
Exactly. He must explicitly disclose that the purpose of the call is to solicit the purchase of securities. Deception is strictly prohibited.
Okay, so Benny does a week of cold calling, and he absolutely hates it. People are mean to him. They hang up on him. It's brutal.
It's a tough job.
He decides he wants to pivot to something infinitely more scalable. He wants to send out a mass email blast. He drafts a fiery email about the market and prepares to hit send to 1,000 people.
Oh, no.
The moment he does this, we leave the world of telemarketing and trigger an entirely different, much stricter set of FINRA tripwires regarding public communications. Welcome to segment 2.
Yes, we do. And this is Annuera Rule 2210. This is the rule that gives compliance officers nightmares because everything a broker-dealer writes, records, or broadcasts to the public falls under this umbrella.
So they don't just treat all emails the same.
FINRA doesn't look at communications as one big blob. They force every single piece of communication into one of 3 distinct categories.
And how do they decide which bucket a communication falls into?
It is based entirely on 2 metrics, the size of the audience and the type of audience.
Okay, let's dissect the first category. Retail communication. What makes something a retail communication?
The definition is highly specific. A retail communication is any written or electronic communication distributed or made available to more than 25 retail investors within any 30 calendar day period.
More than 25. So 26 is the magic trigger number.
Exactly, 26 or more retail investors. And because this is going out to a broad swath of the general public people who might not be financially sophisticated, it requires the absolute highest level of regulatory scrutiny.
Which means Manager Mike has to get involved.
Yes, a registered principal, like Manager Mike, must review and pre-approve this communication before it is ever sent.
Pre-approval. So Benny cannot draft his fiery market update and just click send. He has to submit it to Mike. Mike has to read every word, check it for compliance, sign off on it, and then Benny can send it.
Correct. If he sends it without that pre-approval, it is a massive violation.
What if Benny thinks that's too much friction? He just wants to email a few clients quickly. What's the second category?
The second category is correspondence. This is any written or electronic communication distributed to 25 or fewer retail investors within any 30 calendar day period.
So if Benny selects 20 clients from his CRM and sends them an email about a new bond offering, that is correspondence. Does Manager Mike have to read that email before it goes out?
No, he doesn't. Correspondence does not require principal pre-approval. It only requires general firm supervision.
Okay, so what does that look like?
The firm will have policies. Maybe they randomly sample and read 5% of all emails after the fact to make sure brokers aren't doing anything crazy, but there is no bottleneck of pre-approval holding up the email.
Okay, listener, pay very close attention here because I am about to walk into a mathematical trap, and I want you to see exactly how the exam will frame this.
It's such a classic
Well, let's say it is November 1st. Benny sends a beautiful, well-researched market commentary email to 15 of his best retail clients. 15 is less than 25, so that is correspondence. He doesn't ask Manager Mike for approval. He just sends it. Total legal, right?
Yes. On November 1st, that is a perfectly compliant piece of correspondence.
Okay, now it's November 20th. Benny is feeling lazy. He hasn't written anything new. He thinks that email from the 1st was great. So he takes that exact same email, copy-pastes it, and sends it to 15 different retail clients.
Oh.
He thinks to himself, 15 is less than 25, so this is also correspondence. No pre-approval needed. What just happened?
Benny just walked into a buzzsaw. He committed a major compliance violation.
Why? Each send was only 15 people.
Because the rule does not care about how many people you put on a single email thread. The rule says within any 30 calendar day period.
Oh.
On day 1, he sent it to 15 people. On day 20, he sent the exact same material to 15 new people. That is a cumulative total of 30 retail investors within a 30-day window.
The mass aggregates.
Exactly. The moment he hit send on the second batch, the total crossed the 25-person threshold. That email retroactively and instantly transformed from correspondence into a retail communication.
Which means Manager Mike was legally required to pre-approve it before it was ever used.
Yep. Because Mike didn't pre-approve it, the firm is now in breach of FINRA rules.
That is insidious. The cumulative 30-day math is always lurking on the exam. You have to track the window. Okay, so we have retail communication, which is more than 25, and correspondence, which is 25 or fewer. What is the third bucket?
The third is institutional communication. This is defined as any written or electronic communication that is distributed or made available exclusively to institutional investors.
Define institutional investor for me. We aren't talking about Kathy.
No, not at all. We are talking about banks, savings and loans, insurance companies, registered investment companies like mutual funds, or any entity with total assets of at least $50 million.
The heavyweights?
Right. These are the heavyweights. They are highly sophisticated. They don't need the SEC holding their hand.
So because they are sophisticated, what are the rules for Benny communicating with them?
There is no principal pre-approval required for institutional communication, regardless of how many institutions you send it to. Benny could email 500 banks at once, and Manager Mike doesn't have to read it beforehand.
Wow, okay.
It is subject to post-use review and general supervision, much like correspondence.
Okay, let me try to break the rule again. Let's say Benny drafts an incredibly complex option strategy proposal. He emails it to 50 hedge funds and banks.
Okay, totally fine so far.
But because he's proud of his work, he decides to CC his Uncle Bob, who is a retail investor, just to show off how smart he sounds. Uncle Bob is one guy. The other 50 are massive institutions. Does this remain an institutional communication?
Absolutely not. FINRA uses a strict one bad apple mechanism here. Did you notice the word I emphasized in the definition earlier? The communication must be distributed exclusively to institutional investors.
Exclusively, so zero exceptions.
Zero. The very second Uncle Bob, a retail investor, is added to that distribution list, the entire document instantly loses its institutional status. It becomes a retail communication.
Oh, man.
And because it went to 51 people total and includes a retail investor, Manager Mike needed to pre-approve it. Benny is in trouble again.
I love how fragile these definitions are if you don't pay attention. Now, regardless of whether it's an email to Uncle Bob or a glossy brochure sent to 1 million people, what actually dictates what Benny can say?
Right, the content.
Let's talk about content standards. Can Benny send out an email with a giant rocket ship emoji saying, "This lithium mining stock is guaranteed to double in 30 days. You literally cannot lose money"?
This is where we get into the philosophical core of FINRA's communication rules. All communications must be fair, balanced, and in good faith. You cannot use exaggerated, unwarranted, or misleading statements.
So the rocket ship emoji is out.
It's out. And more importantly, you cannot cherry pick the upside. If you are going to discuss the potential benefits of an investment, you are legally required to provide a balanced discussion of the corresponding risks.
So he can't just hype it up.
Right. You can't just talk about the dividend yield without mentioning that the principal value of the bond could plummet. Furthermore, you cannot predict or project future performance.
No crystal balls. You can't guarantee a return unless it's a specific product like a U.S. Treasury where the government guarantees it. Okay, what if Benny wants to be an influencer? He's tired of sending emails. He wants to go on a popular financial podcast, or maybe he rents out a conference room at the local Holiday Inn to give a live seminar to 50 people.
Okay, live events.
How do the rules handle Benny speaking live? Does Manager Mike have to pre-approve every word that comes out of Benny's mouth?
No, that would be impossible. Live interactions like unscripted podcast interviews, live seminars, radio call-in shows, those are classified as public appearances.
And what are the rules for a public appearance?
The firm must have written procedures to supervise these appearances. They have to train Benny on what he is allowed to say and ensure he understands the fair and balanced content standards. But Manager Mike does not need to pre-approve a script, assuming there even is one.
Okay, here is the twist. Benny gives a great seminar at the Holiday Inn. It was unscripted, it was a public appearance, but he had his buddy film it on an iPhone. A week later, Benny takes that video file and emails it to 30 of his retail clients who couldn't make it to the seminar. What just happened?
The format just changed. It is no longer a live, unscripted public appearance. It is now a recorded, distributed piece of electronic media. And because he sent it to more than 25 retail investors in a 30-day period...
It crossed the threshold. It became a retail communication.
Exactly. And therefore, the video file itself required Manager Mike's pre-approval before Benny hit send. What was legal to say live in a room becomes highly regulated the moment it is recorded and distributed.
That is such a classic exam trap. Okay, one last thing on communications. Does Manager Mike ever have to take these emails or brochures and actually mail them to FINRA? Or does the oversight stop at the firm level?
In most cases, it stops with the firm keeping the records. However, there are strict filing requirements for certain situations. If a broker-dealer is brand new, like they are in their first year of FINRA membership, they are considered unproven.
So they get watched more closely.
Right. For that entire first year, they must file all their retail communications with FINRA at least 10 days before they use them. FINRA wants to babysit them until they prove they understand the rules.
And what if it's an established firm, but they're selling something highly complex, like options?
Options are heavily policed. Retail communications concerning options generally must be filed with FINRA 10 days prior to use, regardless of how long the firm has been in business.
Because options can absolutely vaporize a retail investor's portfolio if they don't understand them. Okay, let's move the story forward into segment 3. Benny gets his retail email pre-approved by Mike. He sends it out compliantly, and it actually works. Customer Kathy gets the email. She likes Benny's analysis, and she calls him up. She says, Benny, I want to open an account with you.
This is a critical moment, because before Benny can accept a single dollar from Kathy or recommend a single stock, he has to pull back the curtain on her entire financial life.
Right. We are entering the world of KYC and privacy. KYC stands for Know Your Customer. This is FINRA Rule 2090. What is the actual mandate here?
The rule requires that every broker-dealer must use reasonable diligence to know and retain the essential facts concerning every single customer.
Essential facts sounds pretty vague. What exactly is Benny interrogating Kathy about?
He is building a comprehensive psychological and financial profile. He needs to know her age, obviously. He needs to know her employment status. Is she a corporate executive with restricted stock?
Okay, that makes sense.
He needs her investment objectives. Is she looking for aggressive growth, or does she need safe, steady income to live on? He needs to evaluate her risk tolerance. If the market drops 20%, is she going to panic and sell everything or ride it out?
And he needs hard numbers too, right?
Absolutely. He needs her annual income, her overall net worth, her tax bracket, and her liquidity needs. When is she going to need to turn these stocks back into cash? Next year? To buy a house, or in 20 years for retirement?
Okay, time to pause. Listener, I want you to really think about this next scenario. Let's say Kathy is a total control freak. She tells Benny, look, I want to open a brokerage account here because your trading platform is fast. But I am entirely self-directed. I'm going to pick all my own stocks. I do not want your advice. I do not want your recommendations. I don't even want your opinion. Just execute the trades I tell you to execute.
Okay, a self-directed account.
Right. Think about it for a second. Does Benny still need to put her through the entire KYC interrogation if he isn't giving her any advice?
That's a great question.
The answer is absolutely yes. He must KYC her. But why? If he's just a passive order taker, why does he need to know her risk tolerance or her net worth?
Because KYC is not just about giving suitable advice. It is foundational to the integrity of the financial system. The rule states the firm must know essential facts to effectively service the account, to know who actually has the authority to act on it, and crucially, to comply with anti-money laundering laws.
The Patriot Act.
Exactly. You cannot let a stranger wire $3 million into your brokerage firm, trade a bunch of penny stocks, and wire the money to the Cayman Islands and just say, well, they were self-directed, I didn't ask any questions.
That would be a disaster.
You have to know who they are, where their money came from, and whether their trading activity makes sense for their profile. KYC is universal. Advice or no advice?
That is a massive distinction. Okay, so Benny does his job. He interrogates Kathy. He gets her social security number, her total net worth, the fact that she's going through a messy divorce, incredibly sensitive private information. How does the firm legally handle this treasure trove of data?
This brings us to Regulation SP, which was born out of the Graham-Leach-Bliley Act. Reg SP is the ultimate privacy rule in finance. It revolves entirely around protecting what we call NPI, non-public personal information.
NPI. Give me the boundaries of that. What is NPI and what isn't?
If Kathy's phone number is listed in a public directory, that is not NPI. But her social security number, her exact account balances, her transaction history, the fact that she owns 10,000 shares of Apple, that is all non-public personal information. To handle this, Reg SP requires Benny's firm to provide Kathy with a formal privacy notice.
When does she get this notice?
She must receive an initial privacy notice at the very start of the relationship, no later than when the account is opened. And she must receive an updated notice annually for as long as she remains a customer.
Okay, let's talk about the mechanics of this privacy notice, because this involves behavioral economics, and the exam loves to test the precise mechanism of how data sharing works. I want to use an analogy. I want you to think of Kathy's private data like water in a plumbing system.
I like this.
When she opens her account, the firm has a faucet that connects her data to outside, non-affiliated third parties, like marketing firms, data brokers, or aggressive credit card companies. When the account is opened, What is the default setting of that faucet? Is it off or is it on?
The default setting is on. The baseline assumption under Regulation SP is that the broker-dealer is legally allowed to share your NPI with outside, non-affiliated companies.
Which shocks most people. They assume their bank is a vault. So if Kathy wants to stop her data from flowing to these third-party marketers, what must she do?
She must actively opt out. The burden is entirely on the consumer. The privacy notice will provide a reasonable means to opt out, a toll-free number to call, a checkbox on a web form, or a prepaid envelope to mail back.
And if she ignores it?
If Kathy gets the privacy notice, gets distracted, throws it in the recycling bin, and takes no action, the faucet stays on. Benny's firm is legally permitted to monetize and share her data with non-affiliates.
It is opt out, not opt in. And this is exactly why the financial industry lobbied for this. They know human nature. They know 90% of people will never bother to fill out the form, which means the data keeps flowing. Now, what if Benny's firm wants to share Kathy's data with their own sister company? Let's say Benny works for a massive bank, and they have an affiliated mortgage lending division under the same corporate umbrella. Do they need an opt-out for that?
No, sharing with affiliates is treated entirely differently. They can share your data freely within their own corporate family to cross-sell you products, and Reg SP does not require them to give you an opt-out right for that. The opt-out is strictly to prevent data from leaving the corporate family and going to non-affiliated third parties.
Okay, but even with the faucet running wide open, even if Kathy throws the notice in the trash and never opts out, there has to be a limit. This is where the exam tries to get you. There are two specific pieces of information that Benny's firm can never, under any circumstances, share with a non-affiliated marketing company. What are they?
Account numbers and access codes, like PIN numbers, passwords, or routing digits. It does not matter if Kathy failed to opt out. The firm is under an absolute ironclad prohibition against sharing actual account numbers for marketing purposes.
Because that crosses the line from annoying marketing into facilitating pure fraud.
Exactly. You can tell a marketer she has a high net worth, but you cannot hand them the keys to her vault.
Okay, segment 4. The account is open, the data is secured. Now we reach the absolute core of the broker-client relationship. Benny wants to earn his commission. He didn't open this account just to stare at it. He calls Kathy up and pitches her a wild new tech stock. This triggers the rules of giving advice, which is heavily tested. Let's unpack the difference between regulation best interest and FINRA's suitability.
Before we compare them, we have to define the trigger. Both of these rules lay dormant until a specific event happens, a recommendation. Not every conversation Benny has with Kathy is a recommendation.
Right, so where's the legal line?
The SEC looks at whether the communication could reasonably be viewed as a call to action. If Benny says, "Hey, Kathy, I was reading an article about the semiconductor industry. It's pretty fascinating how supply chains are shifting." That is general financial education. He's not telling her to do anything.
Okay, just shooting the breeze.
But if Benny says, "Kathy, based on your heavy exposure to real estate, you should buy 1,000 shares of XYZ microchips today to diversify," that is a clear, specific call to action. He nudged her. That is a recommendation.
Okay, let me give you the different scenario. What if Kathy calls Benny out of nowhere? Benny hasn't spoken to her in a month. She calls him and says, "Benny, I was at the country club and my neighbor's husband told me that ABC Corp is about to be acquired. Buy me 5,000 shares of ABC Corp right now." Benny thinks ABC Corp is a terrible company and a totally inappropriate stock for her. What does he do?
That is an unsolicited trade. Benny didn't nudge her. The idea originated entirely with the customer. And this is a massive exam concept. If a trade is purely unsolicited, neither regulation best interest nor FINRA suitability rules apply to that specific transaction. Benny is just an order taker.
Wait, really? Even if he thinks it's a terrible idea, he just executes it.
He might verbally warn her as good practice, but legally he is not making a recommendation, so he cannot be held liable for it being unsuitable. He marks the order ticket unsolicited to create a paper trail proving it was her idea, and he places the trade. The burden of suitability is completely bypassed.
That is fascinating. The rules only engage when the broker acts as the catalyst. Okay, but let's go back to the scenario where Benny is the catalyst. He calls Kathy, he pitches the semiconductor stock, he makes a recommendation. This triggers regulation best interest, commonly known as Reg BI. First question, who does this rule apply to?
Reg BI applies only to retail customers. Customers like Kathy who are using the investment for personal, family, or household purposes. It does not apply when Benny pitches a stock to a massive hedge fund.
And what does Reg BI actually demand? The phrase "act in their best interest" sounds great, but it's fluffy. The SEC doesn't write fluffy rules.
You're right, they don't. Reg BI is highly structured. It establishes that when a broker makes a recommendation to a retail customer, they must act in the best interest of the retail customer at the time the recommendation is made, without placing the financial or other interest of the broker-dealer ahead of the interest of the retail customer.
So Benny can't sell her a terrible mutual fund just because it pays him a massive commission.
Correct. But as you said, the SEC doesn't just leave it at a broad mission statement. Reg BI is broken down into 4 specific testable component obligations. You need to know all 4. The first is the disclosure obligation.
Let's break that down. How does a firm actually prove they disclosed everything?
The firm must provide, Kathy, in writing, full and fair disclosure of all material facts relating to the scope of the relationship and all conflicts of interest. In practice, the SEC mandated a new document to handle this called Form CRS, the Customer Relationship Summary.
The exam loves Form CRS. What does it physically look like? I'm picturing a 50-page legal contract that no one reads.
The SEC specifically designed it to not be that. Form CRS is strictly restricted to 2 to 4 pages maximum. It must be written in plain, accessible English. It outlines the types of services the firm offers, the fees the customer will pay, how the broker is compensated, and critically, whether the firm or its financial professionals have any legal or disciplinary history.
So if Benny was suspended by FINRA 3 years ago, that has to be disclosed right up front on page 2. When does Kathy get this form?
Before or at the earliest time of a recommendation or account opening, it sets the baseline of transparency.
Okay, obligation number 2 under Reg BI, the care obligation.
This means Benny must exercise reasonable diligence, care, and skill in making the recommendation. He can't just throw darts at a board or blindly pitch whatever stock his boss told him to push.
Right.
He must understand the potential risks, rewards, and costs associated with the product, and he must genuinely believe it is in Kathy's best interest based on her specific KYC profile.
He has to actually do the homework. Obligation number 3, the conflict of interest obligation. This is where it gets incredibly tricky.
It is. Historically, brokers operated with massive conflicts of interest. They would receive secret bonuses or trips to Hawaii for selling specific high-fee mutual funds over cheaper alternatives. Reg BI says that simply disclosing a conflict is no longer enough.
Wait, really? They can't just write, "I am getting a kickback" in the fine print and wash their hands of it?
No, that was the old way. Under Reg BI, the firm must establish written policies designed to identify, disclose, and mitigate or eliminate conflicts. For example, Reg BI explicitly bans sales contests, quotas, or bonuses that are based on the sale of specific securities within a limited time frame.
So the firm literally has to restructure how Benny gets paid, so he isn't financially incentivized to act against Kathy's best interest.
Exactly. Mitigation is the key word. They have to reduce the friction between his wallet and her portfolio.
And the final obligation, number 4, the compliance obligation.
This requires the firm to establish written policies and procedures to actually ensure compliance with Reg BI as a whole. This is manager Mike's domain. He has to build the internal systems to monitor Benny and enforce the first 3 obligations.
Okay, so Reg BI has 4 pillars: disclosure, care, conflict, compliance. But I am confused, because anytime I read about broker regulations, I hear about FINRA Rule 2111, which is suitability. Are best interest and suitability the same thing?
They are related, but they operate on different levels, and you need to understand the side-by-side comparison for the exam. Regulation best interest is an SEC rule. It imposes a higher, stricter standard, literally best interest, but it only protects retail customers.
And suitability.
FINRA suitability is a slightly lower standard. It basically requires that a recommendation makes general sense and isn't wildly inappropriate. However, suitability applies much more broadly. It covers institutional clients, hedge funds, and entities that Reg BI ignores.
Let's dissect suitability. It has 3 distinct layers. What is the first layer?
The first layer is reasonable basis suitability. This requires Benny to perform due diligence on the product itself. He has to look at the semiconductor stock and conclude that it is a legitimate investment that would be suitable for someone in the world. He has to understand its mechanics. If it's a completely fraudulent shell company, it fails reasonable basis suitability immediately.
Okay, it passes the sniff test. It's a real stock. What's layer 2?
Customer-specific suitability. This is where Benny connects the product to the person. The stock is real, but doesn't make sense for Kathy.
Right.
If Kathy is an 85-year-old widow living on a fixed income, a highly volatile microcap tech stock fails customer-specific suitability, even though the stock itself is a real product.
It has to match your KYC profile. And what is the third layer? This is the one that really catches behavioral misconduct.
Quantitative suitability. This rule looks beyond a single trade and evaluates the broker's behavior over time. It looks at the entire series of recommendations taken together.
I want to build a scenario to illustrate this. Let's say Benny recommends that Kathy buy a classic, safe, blue-chip dividend stock. It passes reasonable basis. It's a great company. It passes customer specific. It fits Kathy's need for income perfectly. But then Benny tells Kathy to sell that stock on Tuesday, buy it back on Wednesday, sell it on Thursday. He has her trade the exact same safe stock 50 times in a single month. What is he doing?
He is churning the account. Every single time she buys or sells, Benny generates a commission. Even though the stock itself was perfectly suitable for her, the quantity and frequency of the trading were designed solely to enrich Benny while eating Kathy alive in transaction fees.
So if Manager Mike is reviewing trade logs and sees 50 trades in a month on a conservative income account, alarm bells should be ringing.
Massive alarm bells. Mike would step in immediately, freeze the activity, and flag Benny for a severe violation of quantitative suitability. The trading volume must align with the customer's best interest, not the broker's desire to hit a revenue target.
Churning is such a classic exam trap. Okay, segment 5. Let's assume Manager Mike stops the churning, resets Benny's behavior, and Benny finally makes a single, high-quality, compliant trade for Kathy. The order is placed. The stock is purchased. What actual piece of paper lands in Kathy's lap?
The immediate paper trail is governed by SEC Rule 10b-10, which dictates the requirements for trade confirmations. A confirmation is the official, binding record of a completed transaction.
I like to explain this using a grocery store analogy. When you walk out of a supermarket, the cashier doesn't just hand you a blank piece of paper that says, food, $100. That would be insane. If you get an itemized receipt, it lists the exact brand of cereal, the exact price per pound of apples, the time you checked out, and the total tax. The SEC demands the exact same level of granular detail for securities. What specific data points have to be on this trade confirmation?
It's an extensive list. It must include the date and time of the transaction, the identity of the security, usually the CUSIP number, which is like the barcode for a stock, the exact price per share, the quantity of shares purchased or sold, and the settlement date.
Let's talk about the why for a second. The confirmation also requires the firm to state the capacity in which they acted. They have to declare whether they acted as an agent or as a principal on this specific trade. Why does Kathy care? Why does the SEC force them to reveal this?
Because it is the only way Kathy can follow the money and see exactly how Benny's firm profited off her trade.
Break that down. What happens if they act as an agent?
If the firm acts as an agent, it means they acted purely as a middleman. They took Kathy's order, went out into the open market, found a third-party seller, and connected them. For providing this matchmaking service, Benny's firm charges Kathy a transparent, itemized commission. It will literally say on the receipt, commission, $15.
Okay, what if they act as a principal?
If they act as a principal, they are not a middleman. They are a dealer. They sold Kathy the stock directly out of the firm's own private inventory. When they do this, they don't charge a commission, they charge a markup. They bought the stock wholesale for $10 and they sold it to Kathy retail for $10.50. The SEC requires the firm to disclose this markup so Kathy knows exactly how much the firm made off the spread.
Transparency is everything. The firm cannot hide how they are extracting wealth from the transaction. Here is a massive exam trap, listener. When does this highly detailed confirmation actually have to be delivered to Kathy? Does Benny have to email it to her the precise microsecond she clicks buy?
No. Trade confirmations must be given or sent at or before completion of the transaction, which in industry terms means at or before settlement.
What's the difference between the trade date and the settlement date?
The trade date is the day you agree to the deal and lock in the price. The settlement date is when the cash and the securities actually change hands and legal ownership transfers. For most stocks, settlement is 1 business day after the trade date, known as T+1. The confirmation must be sent by the time the trade settles.
Got it. And to circle back to our earlier point, the confirmation must also explicitly state whether the trade was solicited or unsolicited. Again, building that paper trail of who actually generated the idea. So that's the immediate receipt. But what about the broader picture? A FINRA Rule 2231 deals with account statements.
Yes. A trade confirmation is a microscopic view of one event. An account statement is a macroscopic summary of the entire account, all current positions, cash balances, and recent activity.
Okay, let me put you in the hot seat with a scenario. Let's say Kathy buys 1,000 shares of a tech stock in January. She gets her trade confirmation. Then She does absolutely nothing for the next 6 months. She doesn't buy, she doesn't sell, she doesn't deposit any cash. The tech stock is incredibly volatile, so the value of her account is wildly vibrating up and down every single day. The price is moving constantly. Does Benny's firm have to send her a monthly statement in March? Think about it for a second.
It's a tricky one.
The firm does not have to send a monthly statement. They only have to send one quarterly.
Exactly.
But the value of the account is changing every day. How is that not activity?
This is a crucial distinction. Mere price fluctuation in the open market is not considered activity for the purposes of generating a statement. Activity is defined as a transaction, a purchase, a sale, a cash deposit, a withdrawal, or the receipt of a dividend or interest payment. If none of those physical events occur, the account is considered dormant for that period.
And what is the minimum frequency for dormant accounts?
Quarterly. If there's no activity, statements go out quarterly. If there is activity in a given month, say she earned a $5 dividend, then a monthly statement is triggered.
Excellent. Make sure you know the difference between price movement and actual activity. Okay, we're moving to segment 6, customer protection. Kathy hits her quarterly statement. She opens it up. She sees she has $400,000 in cash sitting in the account and $200,000 in fully paid stock.
Oh.
It looks beautiful on paper. But Kathy is a worrier. She watches financial thrillers. She thinks to herself, where actually is my money? I see numbers on a screen, but what if Benny's firm is secretly bankrupt? What if manager Mike is taking my cash and using it to pay the firm's electric bill?
It sounds paranoid, but historically, before modern regulations, that exact kind of commingling and theft happened frequently. Brokerages would use customer assets to fund their own reckless proprietary trading, and when they blew up, the customers lost everything. To prevent this, the SEC built an incredibly robust regulatory safety net, primarily governed by SEC rules 15c33 and 15c31.
Let's look at the first layer of the shield. 15c33, which is the customer protection rule. What does this actually physically require the firm to do?
It requires absolute segregation of assets. The core principle is that a broker-dealer cannot use customer funds or securities to finance its own operations. It has two main pillars. First is physical possession or control. The firm must maintain strict possession of all fully paid customer securities.
Explain fully paid.
It means Kathy didn't use a margin loan to buy the stock. She paid for it in full with her own cash. Because she owns it outright, Benny's firm cannot lend those shares out to short sellers, and they cannot pledge those shares as collateral for a bank loan to fund the firm. Those shares are mathematically locked away in a digital vault with her name on them.
That protects the $200,000 in stock. But what about the $400,000 in raw cash she has sitting there? Cash is fungible. It's easy to steal.
That brings us to the second pillar, the special reserve bank account. The firm has to calculate the net cash it owes to all its customers, and it must deposit that exact amount into a dedicated separate bank account that is labeled for the exclusive benefit of customers.
And the firm can't touch it.
The firm absolutely cannot touch it. They can't use it for payroll. They can't use it to pay their rent. They can't use it to settle their own trades. It is a segregated pool of liquidity. Furthermore, FINRA Rule 2150 explicitly reinforces this by completely prohibiting commingling. Manager Mike cannot mix Kathy's assets with the firm's working capital.
Okay, that protects the customer from the firm. What about the firm protecting itself? What is 15c31?
That is the net capital rule. 15c33 protects the customer's assets, but 15c31 ensures the firm itself has a minimum financial cushion to survive market shocks. It requires the broker-dealer to maintain a highly specific level of liquid net capital. If their net capital drops below that minimum threshold, regulators step in and shut the firm down before it can spiral into a deeper crisis.
But let's say the absolute worst-case scenario happens. The firewalls fail. Manager Mike has a breakdown and quits. Benny inadvertently installs malware on the servers. A massive systemic accounting fraud is uncovered, and the entire firm collapses in a fiery heap. Millions of dollars of customer assets are just missing. Where does Kathy turn?
She turns to SIPC, the Securities Investor Protection Corporation. SIPC was created by Congress in 1970. It is a nonprofit corporation that acts as a safety net for investors when a broker-dealer fails financially and customer assets are missing from the vault.
Listener, grab a pen because you absolutely need to know how to do SIPC math. I want to set up the disaster using an analogy. Imagine SIPC coverage as a specialized, heavily armored suitcase. When your brokerage firm fails, SIPC walks into the rubble and hands you this suitcase so you can carry your recovered assets out. How big is the overall suitcase?
The total capacity of the SIPC suitcase is $500,000 per separate customer capacity. That is the absolute maximum they will reimburse for your combined securities and cash.
But inside this $500,000 suitcase, there is a smaller zippered pocket specifically designated for cash. And that pocket has a strict maximum limit. What is it?
The maximum sublimit for cash reimbursement is $250,000.
Okay, let's put this into practice and do the side-by-side math with Kathy's account. Remember her balances. She has $200,000 in fully paid stock and $400,000 in cash sitting in her account. The firm fails. The vault is empty. She files a SIPC claim. Walk me through the payout. Let's look at the stock first.
Okay, let's pack the suitcase. We evaluate the securities first. Kathy has $200,000 in missing stock. Does that fit inside the $500,000 overall limit? Yes, perfectly. Right. She has $300,000 of room left in the main suitcase. So SIPC replaces her $200,000 in stock.
Great. Now let's deal with her cash. She has $400,000 in cash. Does $400,000 fit into the overall $500,000 limit? Yes, it seems like it should. But, DA, we have to use the special cash pocket. And what is the rule for the cash pocket?
It only holds $250,000. It physically cannot hold more. So she puts $250,000 of her cash into the pocket. What happens to the remaining $150,000 of her cash? It spills out onto the floor. SIPC will not cover it. She becomes a general unsecured creditor of the bankrupt firm for that remaining amount, which usually means pennies on the dollar years later.
So what is her final total SIPC payout?
She gets $200,000 for her stock, plus the maximum $250,000 for her cash. Her total SIPC recovery is $450,000.
Even though her total account value was $600,000, and even though the overall SIPC limit is $500,000, she walks away with $450,000 because she hit the cash sublimit.
That is exactly how the math will appear on the exam. They will give you an account with massive amounts of cash just to see if you remember the $250,000 sublimit. You must evaluate the cash independently first.
Let me throw one more SIPC scenario at you because this is a massive public misconception. Let's say Benny's firm is doing great. They are highly profitable, no fraud, the vault is secure. But Benny recommends that Kathy buy a terrible, highly speculative biotech stock. The drug trial fails, the stock drops 90%, and Kathy loses $500,000 in account value. She is furious. She files a SIPC claim saying she lost $500,000. Does SIPC cut her a check?
Absolutely not. SIPC is not market insurance. It does not protect you against bad investments, market volatility, inflation, or your own poor choices.
Why not? The FDIC protects bank accounts. Why doesn't SIPC protect stock values?
Because of moral hazard. If the government guaranteed the value of your stocks, everyone would just buy the most insanely risky assets possible, knowing the taxpayer would bail them out if it failed. SIPC only protects you against the physical disappearance of your assets due to the firm's failure. If your stock drops in value because it was a bad pick, that is market risk. The stock is still there in your vault. It's just worthless. That is on you.
SIPC protects against firm failure, not market failure.
Okay.
Perfect. Okay, let's look at a different type of disruption. Segment 7, mail holds and continuity plans. Kathy survives the near collapse of the firm. She is incredibly stressed out. She decides she needs a total detox. She is traveling to a remote villa in Tuscany for 4 months. She calls Benny and says, "Benny, I don't want to see a single piece of financial mail while I am gone. Hold my mail. Do not send statements to my house. I'll deal with it when I get back." Let's talk about FINRA Rule 3150, holding customer mail.
We have strict rules for this because historically, mail holds were a primary tool for rogue brokers to commit fraud. If Benny is secretly churning Kathy's account, the easiest way to get away with it is to intercept her statement so she never sees the fees.
Out of sight, out of mind. So how does a firm legally implement a mail hold today?
There are a series of requirements. First, the request must be in writing. A casual phone call from Kathy is not legally sufficient. Second, the written instructions must explicitly specify the time period the mail will be held. And third, this is the most testable part, there are strict maximum time limits based on the reason for the hold.
Let's test those limits. Kathy writes a formal letter. She says, "I am going to Tuscany for 4 months. Having mail pile up at my house is inconvenient. Hold my mail for 4 months." Can Benny execute that request? Think about it.
The answer is no, he cannot.
Why? She put it in writing.
Because the stated reason was convenience. Under Rule 3150, the absolute maximum time a firm can hold mail simply for a customer's convenience is 3 months. If she wants a hold longer than 3 consecutive months, she must provide an acceptable reason.
What qualifies as an acceptable reason?
Safety or security concerns. Or, in Kathy's case, extended travel abroad. But she would have to explicitly state that the reason is extended international travel, not just convenience. If a test question just says a customer wants to hold mail for convenience, the hard cap is 3 months. period.
And while she is sipping wine in Tuscany and her mail is held at the firm, does Benny just get to ignore her account?
No. The firm's supervisory obligations do not pause just because the mail is stopped. Manager Mike must have procedures in place to verify at reasonable intervals that her instructions still apply. The firm must provide alternative methods for her to monitor her account electronically if she chooses. And critically, Mike must ensure that the held mail is actually secure and that Benny isn't secretly tampering with it while she's away.
The principal is always watching. Okay, that covers a disruption for one individual customer. But what if the entire firm faces a disruption? What if a Category 5 hurricane hits the firm's headquarters in Miami, or a massive ransomware attack locks down their trading servers?
That brings us to business continuity plans, or BCPs, governed by a FINRA Rule 4370. Every single member firm, no matter how small, is required to create and maintain a written plan detailing exactly how they will continue to meet their obligations to customers in the event of an emergency.
It's like a fire escape plan, but for capital. What specifically has to be in this plan?
It's extremely comprehensive. It must detail data backup and recovery strategies. If the primary servers flood, where is the secondary server? It dictates alternate physical locations for employees. If the building burns down, where do the traders go to work? And most importantly for the exam, it must outline exactly how customers will be able to access their funds and securities if the firm's normal systems are completely offline.
The customer always needs an exit door. How often does this massive plan need to be updated? Can they just write it in 2010 and forget about it?
No. The BCP must be reviewed at least annually. Furthermore, it must be updated whenever there is a material change to the firm's operations. For example, if the firm switches to a new cloud hosting provider or moves its headquarters to a new city, that is a material change. The BCP must be updated immediately to reflect the new reality.
Okay, here is an exam trap regarding the BCP. Someone has to actually sign off on this document and take legal responsibility for it. Who approves the BCP? It has to be someone who wears two very specific hats at the firm.
The person approving the plan and conducting the annual review must be a designated member of senior management and indeed a registered principal.
So it looks like Manager Mike has yet another job on his plate. He is a principal, and if he's in senior management, he signs the BCP. Okay, we've made it to the final major topic, Segment 8, the paper trail. Decades have passed. Kathy has safely retired. Benny has retired. Manager Mike is now an old man, locked in a subterranean basement surrounded by thousands of cardboard boxes filled with old account forms, trade receipts, and compliance manuals. How long does the firm actually have to keep all this stuff? Let's talk about books and records retention.
This area is governed by SEC Rule 17A3, which dictates exactly what records a firm must create, and Rule 17A4, which dictates exactly how long they must keep them. It is pure memorization, but it is heavily tested because it is the foundation of SEC audits.
I am going to give you a memory aid that will save your life on this section of the exam. If you remember absolutely nothing else about retention periods, I want you to burn this sequence of numbers into your brain. 6543, say it out loud. 6543.
It is the perfect framework. Let's break down the 6543 rule, starting with the longest requirement, 6 years. This applies to the foundational structural records of the firm, sometimes called the Big Three.
What are the Big Three?
First are blotters. A blotter is a daily chronological record of all activity at the firm, every purchase, every sale, every cash receipt, every disbursement. It's the raw diary of the firm. Second are the general ledgers. This is the firm's formal accounting system, tracking assets, liabilities, income, and expenses. And third are the customer account records. This includes Kathy's original account opening forms, her KYC profiles, and her signature cards.
Let me clarify something on that last one. If Kathy opened her account 20 years ago, do they just throw her account form away because it's older than 6 years?
No. For customer account records, the 6-year clock starts ticking after the account is closed. As long as she is a customer, they must keep the records. Once she leaves, they keep them for 6 more years.
Okay, so blotters, ledgers, and customer accounts get 6 years. What about the 5?
5 years is a highly specific, very testable category. It applies to SAR's suspicious activity reports.
Let's contextualize this. Why do SARs exist?
SARs are tied to the Bank Secrecy Act and anti-money laundering regulations overseen by FinCEN. If Benny notices a client making multiple $9,000 cash deposits just under the $10,000 reporting threshold, a technique called structuring, he is legally obligated to file a SAR. The Patriot Act massively expanded these rules after 9/11 to track terrorist financing. When a firm files a SAR, they must keep a copy of the report and all original supporting documentation for exactly 5 years.
5 years for SARs. Got it. Well, what about the 4? This is an exam trap waiting to happen.
4 years is exclusively for customer complaints. FINRA Rule 4513 states that member firms must keep a file of all written customer complaints for exactly 4 years.
Why is this a trap?
Because almost everything else in the industry is 3 years or 6 years. Complaints stand entirely alone at 4 years. The exam will try to trick you into choosing 3 years. If Kathy writes an angry letter because Benny executed a trade poorly, Manager Mike must hold on to that physical or digital letter for exactly 4 years.
Do not get tricked. Complaints are 4 years. And finally, the 3.
3 years is the catch-all for almost everything else. Communications with the public, retail communications, correspondence, trade confirmations, U4 forms for employees, and written supervisory procedures, WSPs. All of these have a 3-year retention requirement.
Okay, so the sequence is 6543, blotters, SARS, complaints, communications. Memorize that. Now, there is a sub-rule that applies across the board to these retention periods. It's called the 2-year accessibility rule. How does this work?
The SEC wants to be able to audit a firm quickly, so they mandate that for the first 2 years of any retention period, the records must be kept in an easily accessible location.
What does that mean practically? Does Mike have to keep the physical paper on his actual desk?
It means it must be immediately retrievable. If SEC examiners walk into the office unannounced on a Tuesday morning, they expect to see the firm's blotter from last week immediately. Manager Mike cannot say, "Oh, we shipped those files to a deep storage salt mine in Utah. It'll take a month to get them." For the first 2 years, they must be on-site or instantly accessible digitally. After those first 2 years, Mike can move them to cheaper, long-term archival storage as long as he keeps them for the remainder of the 6-year term. It's a time frame within a time frame.
Now, obviously, we aren't using cardboard boxes and filing cabinets much anymore. Everything is digital. Can Manager Mike just keep all these records in a standard Google Drive or a Word document on his laptop?
Absolutely not. The rules for electronic storage are incredibly strict to prevent brokers from altering history. The storage system must meet one of 2 rigorous standards. The primary standard for a long time has been WORM.
Worm. Write once, read many. Think of worm storage like carving the record into a literal stone tablet. Once Manager Mike hits save on that daily blotter, the file is cryptographically locked forever. It cannot be altered. It cannot be overwritten. It cannot be deleted by anyone, not even the IT department, until the 6-year retention period legally expires.
The alternative method the SEC recently allowed is called the audit trail alternative. This is a bit more flexible, but equally rigorous. The system allows you to edit or update a record, but it meticulously tracks every single keystroke. It saves every prior version, notes exactly who made the change, what time the change was made, and what the data looked like before the change.
So if Benny realizes he made an illegal trade and goes into the system to quietly delete the record, the audit trail flags the deletion, saves the original trade, and puts Benny's digital fingerprints all over the crime scene.
Exactly. Either way, worm or audit trail, the entire goal is preserving the unassailable integrity of the historical record. You cannot hide your tracks from the regulator.
Wow. We have covered a mountain material today. We went from cold calling to digital cryptography. Let's do a rapid-fire recap to lock these testable facts into your short-term memory before you take your practice exams. I'll throw the topic. You give the rule.
Let's do it.
Telemarketing calling hours.
8:00 a.m. to 9:00 p.m., and it is always based on the customer's time zone.
The threshold for a retail communication.
More than 25 retail investors in a 30-day period, and it strictly requires principal pre-approval.
The default setting for Reg SP privacy sharing.
The faucet is on us. The firm can share with non-affiliates. The customer must actively opt out to stop it.
Regulation best interest. Who does it apply to and what are the pillars?
It applies only to retail customers. The 4 obligations are disclosure, care, conflict of interest, and compliance. And remember, unsolicited trades bypass this entirely.
The SIPC limits.
The total suitcase is $500,000, but the cash sublimit is strictly capped at $250,000.
Holding mail for mere convenience.
3 months maximum. Any longer requires a valid reason like extended travel.
And the master retention record rule.
6543. Blotters are 6, SARS are 5, complaints are 4, communications are 3.
Incredible. We have spent this entire deep dive talking about the intricate guardrails, the firewalls, the compliance checklists. All of these rules, Reg BI, the customer protection rule, the DNC lists, they were meticulously designed by the SEC and FINRA to protect you, the investor, from bad actors, systemic risk, and outright theft.
It really is a massive invisible infrastructure of trust that keeps the capital markets functioning. But it raises a deeply provocative behavioral question. We spent a lot of time talking about Form CRS, privacy notices, and the customer's right to opt out. I want you to ask yourself, In your actual day-to-day life, how much of that legally mandated fine print do you genuinely read? When your bank sends you an updated Reg SP privacy notice in the mail, do you read the terms of how your data is monetized, or do you just throw it in the trash? When an app asks you to agree to a new relationship summary, do you read it, or do you just click, I agree to make the pop-up go away so you can see your account balance?
The regulators have fought for decades to force Wall Street to give the public the tools to protect themselves through transparency. But the entire system relies on the assumption that the public will actually pick those tools up and use them. It's the illusion of protection if you refuse to engage with it.
Exactly. Disclosure only works if there is comprehension.
And think about this from the technology side. We just finished by talking about the SEC requiring worm storage right. Once, read many. The foundational premise of that regulation is that these digital records are mathematically locked by cryptography and can never, ever be altered for the entire 6-year retention period. But look at where computing is heading. What happens in 5 or 10 years when quantum computing reaches maturity? When a quantum processor can break modern RSA encryption algorithms in seconds, will the legal concept of an unalterable digital record even exist anymore? How does the SEC regulate an audit trail when the fundamental laws of cryptography are broken and rewritten?
The rules will inevitably have to evolve, just as they evolve from paper ledgers to digital servers. The technology changes, but the regulatory intent remains the same.
It's an arms race between compliance and capability. Something to chew on while you take those practice exams. Keep studying, keep asking why the rules exist, and we will catch you on the next deep dive.